Hey, hope you're enjoying the summer. Got another recording here. Lots of charts to share with you where we've been, where we're going. We're 6 months through the year, into July now. So I'll show you where we've been as far as the first half of the year and what the outlook might be. Here's a bunch of asset classes. I always talk about global diversification, structuring the portfolios in different asset classes. Here's a great case as to why to do that. You can see how things have changed over time. But looking at 2026 there, you can see small caps at the top. Also looking, you got commodities, you got mid caps, emerging markets, and developed international markets all at the top there. Canadian specific isn't there, but it was roughly just under 9%, or sorry, just under 10% for the first 6 months. So in all of these cases, a relatively strong first 6 months of the year. But if you look at U.S. growth there, signaling those large cap companies, really only 5% sitting in the middle there. So again, strong case for diversification. If you look at the bottom half, you're seeing a lot of bonds, a lot of fixed income. So those returns, although positive, definitely dragging down the returns for any of your more conservative portfolios. Of course, there's a reason to have those in there, much less volatile than the stock market. And of course, we're looking at a short-term returns there, only 6 months. But if you go all the way to the bottom, you can see gold and Bitcoin down, especially Bitcoin dramatically in the first 6 months of the year. So again, good diversification, global diversification, different asset classes. You're going to mix these together, get a solid return, less volatile as these things flip around year over year, month over month. So we'll keep an eye on all of that. But interesting to see. The more you were in the S&P 500, which is heavy with those U.S. growth companies, those large cap companies, the weaker your return might have been in the first 6 months of the year. Of course, that does not indicate where things could be headed. Where things could be headed. So first quarter, not the greatest with the news in March of the Iran-U.S. war, bringing everything down. But April, May, June, pretty strong months, especially April, May, rebounding from the lows in March. You can see almost 15% on the S&P 500 in the last quarter. Where does that lead us? Looking out one quarter, the combined next 6 months, almost 11.7% for a 6 month return going forward. 90% chance that that happens if you're going back looking at historical data. So you can see how that compares to at the very bottom there, a 5% return with about 72% chance. So strong. What this is indicating is that strong returns like this don't mean that you're going to get a reversal. Often mean that that strength will continue, the momentum will continue positive. Look out a little bit further. You look at the far right column here, the next 4 quarters out, you can see you got 11% upside as an average, 75% of the time being higher. So again, strong returns in a quarter, usually indicating that that momentum will continue. Shorter term, looking at July, the last 11 years have been positive in July. The average of those 11 years up 3%, 3.2%. So interesting to see. We spoke about March earlier. We spoke about June being weak, but especially March being one of the weaker months. We've had the Iran-U.S. war this year. We had the tariff talk last year. We, of course, had the pandemic in 2020. So over the last 10-ish years, March has been the weaker month. July has been one of the strongest months. We'll see if that trend continues for a 12th year here through the summer. Why can it grow? We've talked about this a few times. Earnings expectations continue to grow and continue to outpace where the markets have actually gone. So if those expectations are met or continue to grow as we go through 2027 and into 2028, there's definitely room for that market to keep pace. And it's much broader now than it was a few years ago, where it was just those large U.S. companies really pacing the market. The underlying sectors and geographies as well globally continue to grow. So good case for the markets continuing to run. Maybe not at the pace we saw last quarter, every quarter, but a case for some upside for sure. Economy's actually stronger looking at the U.S. than it seems. Unemployment is under historical averages, and I was reading a report earlier with a lot of cases out there and worry out there that younger people are going to have trouble finding employment with the boost of AI, losing those kind of entry level jobs. That hasn't been the case either. But you can see overall unemployment rate moved up a little bit, but down from the historical averages still. So interesting to see there, and a case that adds to the indication we will have interest rates rising towards the end of the year or into 2027, as opposed to dropping, which is where we were thinking they would go at the beginning of 2026. So time will tell on that. But another indicator is inflation rates, and you can see inflation rates continue to move up here, with both Canada and the U.S. wanting to get those rates down to 2%. We've of course dropped from those pandemic highs, but it's been very sticky, hard to get lower than this 3, or you can see in the US 4.2%. Both have moved higher since the last reading. So another indicator that rates could be moving up in the next 6 to 12 months as opposed to moving down. So keep that in mind. Those are definitely pieces that they are looking at when deciding on interest rates. As always, got one more chart for you. Thought it'd be interesting. Sorry, household wealth held by people over 70, and this is very true, I believe, in Canada as well. You can see going back into the late 80s, 19% was held by people over 70 years old. Now up to 33%, which in a lot of ways makes sense. You've seen real estate increase. You've seen longevity increase as well. So there's more people over the age of 70. Of course, once they pass, those assets may get passed down to somebody under the age of 70, which may have happened a little sooner, going back 30-ish, 35 years, but 33% held by people over the age of 70. So interesting chart there to look at. I'll leave you with that. Back in a couple weeks with more interesting charts as we go through the summer. I hope you're taking time to enjoy and relax in the sunny days with family and friends. We'll